Welcome to Credit Exchange, your weekly podcast where we speak to the biggest newsmakers and news shapers in finance. I'm your host, Lisa Lee. This week, my guest is Bryan Whalen, CIO of Fixed Income at global asset manager TCW. TCW is a fixed income, public equity, and alternative credit shop with $200 billion in AUM, and Bryan's oversees about $170 billion. Welcome, Bryan.
Well, thank you. Thanks for having me.
Bryan, artificial intelligence has been in the news all this year, but particularly this week, I'm glad to have you here because the AI trade seems to be faltering. Lots of questions about whether there's been too much CapEx spending, whether there's going to be enough revenues and cash flow coming in a timely fashion. I would love to hear your view on AI right now.
Sure. Well, first, let me say that I'm a believer. This is a transformational technology for humanity. It's gonna be as impactful as the internet was. So there's no stopping that. So I like to start there. However, the capital spend and the momentum and equity prices, et cetera, is just like nothing we've ever seen before. Just to kind of maybe put this kind of into context, the hyperscalers, which is these big technology companies, your Microsofts, your Amazons, your Oracles, your Metas, exactly. These are companies that kind of pre-2025 were generating about $250 billion a year free cash flow. Their free cash flow this year is probably going to be negative. And the reason is they are spending all of that to basically build these data centers, secure energy, et cetera. And most of that build, in addition to the free cash flow, they're borrowing from the debt markets.
I was going to say, so it's a debt-fueled spending spree.
Yeah, so there's two things unique here: the pace of the capital spend and how quickly this is moving. And then this is the new thing, and this is for the capital markets oriented individuals, the nerds out there who watch the bond market every day like I do. Here's the interesting thing: typically, when we have these moments in history where you have these big capital spends, these borrowers would come to the bond market, and when they borrow too much, the interest rates would go up, and so their cost of borrowing would go up, and that would be like the natural feedback loop for the markets to tell the borrowers, okay, you're going too fast, you got to slow it down, because we're going to raise your prices again.
Is that broken?
It is
that
broken. Yeah, and here's why. And this is, I'm gonna little color here, which is, Mark Zuckerberg. He's putting his head on his pillow at night and he's thinking about things. And let me tell you something. In his mind, what he wants to do with AI, he's thinking about like tripling, quadrupling the value of his equity over the next couple of years, right? So he doesn't care. The math doesn't matter if he borrows the next $20 million at 8% or 7%. It does not matter when you're so convicted in the value proposition for the equity price. And so we have this interesting dynamic where you have these big, gigantic companies who have very strong balance sheets. And while the bond market's trying to slow it down, and by saying it means it's raising the cost of borrowing, these companies turn around and say, we don't care. We're just going to tap another $20 billion. And so it's really impacting the market.
So thank you for explaining that, because I was wondering what was going on. I saw BlackRock. They raised some bonds for a data center, I believe in Texas. And even though it was an IG credit, the pricing was like a junk bond. I think it was like 7.5, a little bit over that. To me, that was a shockingly high price. But what you're saying is the bond market is saying we've had enough. There's indigestion. Slow down. And they don't care. And they'll borrow at rates that most people walk away from. So thank you for explaining that, because that makes a lot of sense. And in fact, it seems like every day they're upping the ante and then raising their CapEx expenditures, right? We've got earnings expected from Microsoft and Meta, I believe, after the earnings close today. We're taping on Wednesday. And I bet you they're going to raise CapEx spending again.
Oh, yeah. And it's not just, let me tell you something. The capital markets divisions of these broker dealers, they're searching the globe to find pockets of capital. So like, it's not just Microsoft and Amazon and all these other hyperscalers borrowing in the US and US dollars. They are borrowing all over the planet. in all different currencies, primarily in the debt markets. They're also selling equity. And they're doing structured transactions, which is something else we should talk about, like highly complex deals that are unlike traditional corporate bonds. And again, it is relentless. The market is already swimming in an amount of oversupply, and there's nothing that's telling us it's going to stop for the foreseeable future.
But what about the fact, so why are we having this indigestion? Why are we having this moment saying no more? Because in the beginning of the year, investors just wanted data center financing, especially if they're from the hyperscalers that they trusted. They were like, we trust Microsoft. We trust Oracle. We trust Meta. And they wanted the debt. There were people, I talked to investors who were waiting for it, saying, I can't wait for more to come into the market. Now that sentiment has shifted very much. Is it because there's now more of a question about when there'll be cash flow positive, when they'll be profitable, I guess is what I'm saying.
Sure. So it's a great way to frame the issue, which is right now, this indigestion, it's just a technical thing. It's a supply-demand conversation. It's not fundamental. We should talk about fundamental, but right now it's and I want to just put this in perspective. So the hyperscalers on average have a AA rating. The corporate bond market on average is about a single A rating. So by ratings, they're higher quality. And up until this year, these hyperscalers have traded basically a tighter spread than the index, lower yield. And that makes sense because they're higher quality. This year alone, that group of hyperscalers has gone from trading with a tighter spread versus the index to almost 50 basis points wide. So basically in a year where the corporate bond index is unchanged, this hyperscaler group has widened out by 0.5 percentage point, 50 basis point. That's a monster move for what is really, honestly, just a technical imbalance of supply demand. Now, if let's say for the rest of the year, if something happens in this AI space where the market starts to question the fundamental elements of the capital spend, and that, by the way, that's not, I'm not saying something extreme like, oh, we got AI wrong and it's not happening. It's just more like maybe the world doesn't need as much compute as it used to. Or maybe China's got Kimi 3 or Kimi 4 or Kimi 5, and that's going to undercut the American AI. Or, maybe the social pushback, right? Like,
governments might push back, right?
Yeah, like people
regulation,
are losing jobs. So whatever place it comes from, or what if Gronk invades the Pentagon and breaks in, overnight because it was just seeing if it could do it. Who knows? Like that's not my area of expertise. But what I'm saying is like if you just have a slight adjustment in if there's a twist and turn in the road of the AI future, and the market starts to have to recalibrate the earnings power of these companies and what they're spending, now it could get really interesting. You could have a fundamental adjustment in cash flow and capital spend. And when you combine that with a market that is like literally choking on the amount of supply, that could create a really interesting dynamic, not just for this sector, but for the market at large.
Because I think we've talked about before that maybe if something like this happened, it could impact sentiment throughout both credit and equities market, and actually even the real economy. We could see a recession possibly if this doesn't pan out the way financially way you expect. Not that, like, I agree with you, not that AI isn't real, not that AI isn't transformative, but it's not financially going the way that people have expected, right? Revenues and profits, which is a whole different thing.
Yeah. Listen, AI, we like to think about AI's contribution to the economy in two ways. You've got the direct way, which is buying chips, building data centers, creating, expanding utilities, power generation capabilities, all the supply chains necessary. That is like a real benefit of AI. Not even talking about the productivity benefits for all different types of companies. That's one, I call that the direct way. The indirect way is the equity valuations of these companies just growing and so fast. It is, it's basically making people feel richer,
really
which
wealthy,
we call the wealth effect.
Mm-hmm.
And when people feel richer,
they spend.
Even if it's on balance sheet, they spend. And so that's kind of the indirect way that AI has been providing stimulus to this economy. So yeah, spot on. Now, so it's almost like this AI economy and its contributions, both direct and indirect, have been all that's mattered for our economy. It's kept it growing at a moderate clip. However, we also know we went through a period of rising prices, wage growth has moderated. We see the level of interest rates really having an impact on like the bottom half of the U.S. consumer. They are really struggling. So if we have a fundamental adjustment in AI, it doesn't contribute to the economy over the next 12 months like it has in the last 12 months, and you remove that, you're not left with a whole lot of strength in the underlying economy. So yeah, it's possible we could have a recession if the AI path is disrupted and takes a downturn.
And so that means even for sectors that aren't directly impacted, a recession would impact all sectors in both equities and credit, and also just, all our lives. We'll see higher unemployment. It's just going to have enormous ramifications immediately. And I'm not talking about the long-term societal impact. I'm talking about the immediate economic impact of it, because to your point, it's been what's driven both the markets and the real economy this year, which has allowed people to honestly, we should start, given what's going on geopolitically, we should have started with Iran and the heightened aggression, but we don't, right? We didn't. That's not what's the headlines, because right now AI news is pushing everything off the headlines in the front pages.
And we are, there's a whole, there's an analysis of like human behavior here, but you and I, we've seen cycles, and we've seen this, both in our careers and in the history books, we read about prior cycles, canals and railroads, and we've seen the technology bubble, and the fiber laying all over the, cable all over the world, and we've seen energy overbuild in oil and gas, and we've seen utility overbuild. So we've seen this before, and here's the thing: it's a revolutionary technology, and the only way to kind of win is to be in it and be in it aggressively. But if history, if it rhymes here, what we're looking at here is just everybody on one side of the boat, too much enthusiasm. And, definitionally, sure, there's going to be some winners in this space, but by gosh, there's going to be some losers too. And right now, I think the danger as an investor is it's really hard to see who's going to lose, but nonetheless, you'll have it. And and market pricing isn't really being discriminatory with regards to winners and losers. And so, it feels... Look, like I said, the impact on our lives is not a bubble. It's true. It's real. It's here. But the pricing of credit spreads, the pricing of equity valuations feels bubble-like.
Yeah, and we're seeing little inklings of maybe bubbles popping, right? I don't normally talk about South Korean stock indices, and yet you see their record decline this month. I think over 30%. Nearly 40% from the top in June. You've got SK Hynix just tumbling the last 2 days, even though they increased profits because they increased investment spending, and they didn't really show a clear way of returning shareholder returns.
Yeah. Well, I think, they call these things like canaries in the coal mine, and I would say, at least in my lifetime and investing career, the only time the whole world kind of, flipped at a 180 overnight was COVID, but outside of that, even the great financial crisis, there was good 18 months.
It took a long time.
It took a long time, and there were little things that happened, right? 100%.
Between Bear and Lehman, there was a long, the two hedge funds,
That's
right?
That's right. And there was also little mortgage originators that went bankrupt. Yeah. So there was all these kind of tea leaves, little things, little signs. So this kind of feels a little bit like that. There's just a little things popping left and right. And it just feels like, we're all standing on this, this metaphorical stool of AI, but and it's got multiple legs. But if you look closely, some of these legs feel like they're cracking a bit. And, that usually is kind of the beginning of the end of the euphoria.
So at least maybe we don't have a financial crisis. Maybe we don't have a bubble bust, but maybe at least, at the very least, a calming of the euphoria, because it does seem we got very, very euphoric, incredibly enthusiastic this year. It's been around for a while. I remember watching TV and people, not, I mean, I don't mean the Terminator. I mean, like just like legitimately other TV shows, Silicon Valley's talking about AI. It's been around and people, I know that many investors have been factoring in AI the last couple of years, but it really feels like it took off in February, really. And the enthusiasm of NVIDIA and also, and IPOs and all the data financing. It has been a crazy ride this year, and was just only into July.
Yeah, completely agree with you. But I would say, people always want in on these things. They want. It's like, oh, maybe this is crypto, maybe this is that. They want to ride it up. I would just say, like, if the momentum turns and this is hitting a downdraft, it's also hard to stop that momentum on the downside. And, one of the things we haven't talked about, but I think it's worth mentioning, which is, this AI ecosystem, where you've got like NVIDIA right here in the middle, and then you got all these ancillary companies like your hyperscalers and your utility company. Like, there's also, you don't have to squint too hard to kind of see some similarities to like prior bubbles where like there's also a lot of interconnectedness on lending and revenues and cash flow. Like, they're all kind of leaning on each other. And if any significant kind of domino in here kind of tips, it will impact. I'm not saying it's a great financial crowd. I'm just saying it will impact a lot of other companies within the ecosystem. And I don't think the market realizes or appreciates how correlated these companies
things are to each other.
To your point earlier, you may not think that Microsoft really connected to like a data center construction company in Texas, but let me tell you something.
Yeah.
They have a high correlation right now, at least the latter to the former. And I think, you talk about how could the AI disruption reverberate to the broader economy. That's exactly how it would happen. Just too many entities kind of interconnected from a financial perspective.
So, Bryan, am I hearing that you think there's a bubble in AI, or do you think you don't know yet, but it looks a bit like a bubble? Where would you call it?
I would say everybody to one side of the boat, the euphoria around valuations of most, if not all, the companies involved in the AI ecosystem, that feels bubble-like. It doesn't mean as a society we have the impact of the technology wrong.
Oh, yeah, just like in the 2001, right? When the tech bubble.
Yeah.
We did with the tech's transformative. Look at us. We're doing a call via
amazing.
Technology, right? And we're Wi-Fi. It's all totally changed. My life is completely changed. Yeah. Nonetheless, there was a lot of companies that went bust and a lot of people lost money.
Exactly. Here's what I would say. My guess is we look back a few years from now, let's say 5 years from now, and we could look on a list of all the companies in the ecosystem, and we would be like, wow, that's right. I forgot about that company. Like it went
remember
bankrupt.
The sock puppets?
Yes. Exactly. Like whatever happened to that? Because everybody thought that was going to be the next big thing. And it's not. So it feels like like that type of environment.
So, Bryan, you manage 170 billion, oversee it for TCW. So you're a big bond shop. So given this, your view of the world and your view of the markets and what you're seeing in AI, how are you positioning it? I know it's impossible to pick all the winners and losers, but surely your viewpoint has an impact in how you're investing.
Yeah, I would say, so at like the highest level, we view an economy, as I kind of indicated earlier, mostly held afloat by AI capital spend and equity and wealth effect through equity valuation. So I would say our view on the economy, it's not dire. We just view it as vulnerable. And, tie that to, the Fed and the Fed decision and interest rates.
I know it's coming in soon,
It's coming up. It's coming up pretty soon. A little bit after this recording, we're going to see what happens here. So, we basically view that, interest rates are still a little high. They're restrictive. They're going to come back down over time. That was the path. That was the expected path. But the war and the pop in energy prices, it's disrupted it. It doesn't stop it. It's just kind of disrupted it.
So you're thinking that maybe we pause, maybe we hike, but we go back down.
Yeah, look. we more likely the view is that they kind of just hold here for a while and let the data provide the confidence that inflation will continue its disinflationary trend.
Because we've had some cooler than expected figures, right?
Much better. Yeah,
right?
yeah. And we think that's going to continue. But, at the other hand, I think the Fed just wants to probably pause here and wait. If they hike once, maybe twice, we don't think we're on a new kind of hiking campaign like we saw, after COVID. This is a different environment. Now, on the credit side, I would say, look, what are we thinking and what are we doing? It's, listen, we're value investors, and I'll tell you this: you can never time the top and the bottom. It's impossible. You may do it once, but you're lucky, and you need to acknowledge that. So, given the cautionary view on AI and valuations, I would say we are keeping a lot of powder dry. We're looking for more attractive valuations to purchase these things. However, we are starting to kind of nibble and dip our toes in the water on some of these bonds, because they get to a point where it's just like, okay, it may get cheaper, but I think long term, I'm going to be happy that I bought at today's levels.
Oh, that's interesting, because now they've spread and wind. The technicals have wind enough that they become attractive, because you really are getting AA companies bonds for like really junk prices, and at some point it makes sense, even if it doesn't pan out the way you expect when the revenue and cash flow side.
If you can buy Amazon, Google, Meta, Nvidia at basically an extra 0.5% of yield versus the rest of the bond market, that's going to be a good long-term investment. Because I'll tell you what, let's just say the whole AI machine stops. Look, we hit a pause.
Which is probably unlikely for the worst scenario. Yes.
Worst scenario. You know what those companies are going to do? Go back to making a killing and on everything else they do in their business. You know what I mean? Like they're going to be just fine. And by the way, then they'll stop issuing all this debt, and the supply technical issue will go away. And you're going to be left with really strong companies with incredible balance sheets. And 50 basis points, 0.5% wide to the corporate bond market over time is going to look like a really good buy.
So that's one buy. What else are you doing? Is there any sectors that you're moving away from? Not because they are going to be AI disrupted, although I would love to talk about software, but because they might be more prone to a downdraft if the AI machine stops.
I would just, there's no I wouldn't say any particular sector looks incredibly vulnerable. I would just say, broadly speaking, corporate bonds are really expensive right now. There's just outside of the hyperscales are really expensive. So, that's another way of saying we just feel like broad risk premium in the marketplace is not really compensating investors for the risks that you and I have kind of already talked about, whether it's in, the hyperscalers or the market at large. So we are underweight corporate bonds. We're very defensive. We just don't think they offer good value, because we think over the next, maybe over the course of this year, there'll be much better buying opportunities when the market more accurately calibrates risk reward.
So where are you pushing more into then? So you're underweight that treasuries, and you invest globally. So maybe you could talk about other regions that you find attractive.
Sure. Yeah. So like right here in the U.S., we are overweight the securitized bond market. So mortgage-backed securities, commercial mortgage-backed securities, asset-backed securities. They're not like screaming cheap historically, but they look a lot better than corporate bonds. And so, you got to get your yield somewhere. And you don't get a lot from treasuries, at least relative to these other sectors. So, we basically have a platform trade on where we are overweight securitized and underweight corporate bonds. That's what we're doing domestically. Internationally, some more interesting things. I'll just kind of a quick list, and we dive in. We've been buying a lot of the high quality sovereigns in the Middle East. Kind of right in the heart of the conflict.
Even though there is a war going on right now.
You know what? Not to be dismissive or insensitive, but these conflicts, these wars, they've happened before. They'll happen again. But these countries we're buying, it's Abu Dhabi, Saudi Arabia, Kuwait, Oman. These companies are going to be just fine. In some ways, they benefited from higher oil prices, and their debt trades really cheap. So we've been buying some of that. There's some interesting opportunities, kind of high quality bonds to buy down under, down in
Oh, in
Australia.
Australia.
Well, yes, yeah, like,
Mm.
Queensland, Victoria, a lot of the they call them the Aussie semis. Think of them as like the equivalent of like municipal bonds here in the U.S. We've been buying a bunch of those bonds denominated in Australian dollars, and we do the hedge back to dollar. But that's an interesting opportunity. And I'll also just say, over at the continent in Europe, a lot of U.S. companies, some of the ones we've named, because the U.S. markets is a little bit full right now. They've been kind of selling debt over there too. And
Yeah, so
so,
the euro denominated version of what you're seeing here, that you
yeah,
actually
we
think
call
they're
it.
better than the dollar bonds.
Well, yeah, because they're cheaper. It's the same company, same risk. But as long as you have the capability to buy euro-denominated Microsoft paper, you buy it and you hedge the currency, take that risk off. You're still left with more yield than if you just bought the dollar bonds from Microsoft. So that's another opportunity. So like, there's nothing globally that is like a buy of a lifetime. But there's certainly interesting opportunities out there to kind of enhance a portfolio in a high quality way.
And then when you we've talked about some of the things you like, and we've talked about your worry about AI. Do you have any other worries? My goodness, we're a good 25 minutes into this podcast, and we haven't even talked about private credit. A few months ago, I would have started with that because that was commanding all the headlines. It's amazing how much this year the winds have shifted.
Yeah, I mean, it was what was the story in late February? It was
going to cause a financial crisis. It was systemic crisis, right?
Then there was cockroaches, right? Remember cockroaches, yes. And it was BDC redemptions, coming through, and oh, by the way, it was also indirect AI. It was like
AI software loans just selling off all software
brokers, like. Basically like the market's being like, okay, I've got like all these sectors to look at. Which ones, what companies in these sectors does the world not need anymore because of AI? And by that cockroaches from private credit, BDC redemptions, like I tell you this, none of that's going away.
No.
It's not gone. It's just back page news right now because the war is front page news and this AI capital spend. But like, make no mistake about it, it isn't gone away. So I wouldn't say any of those issues, I just mentioned would be like significantly upending to an economy or the capital markets. However, just like First Brands and some other companies, they certainly put investors on their heels a bit from a risk perspective. I think we're going to still be dealing with those things, for the next, solid 18 to 24 months.
So is that a place you would invest in, or are you pulled back a little bit? What's your sense of private credit, given that some of the redemptions and the software loan issues, and probably also, they're dealing with some issues of like their own little froth of 2021, 2022, when they probably lent on overly high valuations, probably over-levered companies not getting enough of returns for the risk. They're dealing with that now. They're seeing more non-accruals, and which is to me more of a credit cycle issue rather than perhaps the industry's imploding issue. It's a risk asset, and some people took too much risk. So how do you play that?
I would say, so first of all, even though you'd mentioned what I manage, we've got a fantastic private credit team here.
Oh, good. Not everyone's the same, right? Not everyone's the same.
No. Been doing this for over 20 years. Yeah. One of the original investors in this sector. He's a straight shooter, and what you would hear him say if he was here joining me right now, he would just tell you look, there's been a lot of money in this space. There's pressure to put money to work, and what he would tell you is he has seen. Let's call it a lack of discipline in underwriting and lending, and eventually that comes home to roost.
Yes.
And we saw that in the software space, which we effectively had no exposure to. But now talk about opportunities. I would tell you, pendulum swings both ways. It rarely lands in the middle. So it went from software being aggressively priced with lack of discipline and underwriting, and swung all the way to no one needs software companies anymore. So back in February, March, what we were doing here in fixed income, we were basically in the leveraged loan market buying a number of these software companies that we felt whose business models really weren't under threat from the AI threat, but they were still just trading very
off
cheap because they were called software companies. And so we jumped in and we bought those, and they've mostly remediated. And I think, this kind of sector rotation and re-underwriting sectors and probably too harshly will continue. So, I'd say we look forward to other sectors coming under the AI scrutiny.
Do you have any sense which one they might be? Because we just keep going through, rotating through sectors this year.
Yeah, I feel pretty comfortable giving you this answer. Yeah, all of them. Like they're all, they're all. It's just, we can only process so much. And so what the market does is like, it just, 1 week or month, it focuses on these sectors. And then once it's done with that, it moves on to this and it moves on to that. So we're going to sit back. We're going to let the market reprice different sectors, and we're going to jump in and buy when we feel like the pendulum's gone too far.
So is the software trade, is that over? Has all the money already been made because they sold off and it sort of bounced back? And the ones who haven't are the ones that are actually going to be disrupted, or you think there's still money to be made there?
I think the fast money has been that's been made. I would say often what you see is, the market wakes up and says, "Oh my gosh, software companies, what's going on?" And it punishes everything, right? And then so it all gets cheaper, and then people have a chance to calm down and underwrite and think, and all of a sudden, most of it comes back, not all of it. So I think we're done with that, like that initial knee-jerk trade. I do think though, what we are going to see is that we'll see idiosyncratic opportunities in software for the foreseeable future as the market really starts to not look at it as a sector as a whole, but just looks at it as like individual components. And it definitely will continue to provide opportunities at that level.
Well, all this sounds to me is that you're going to be very busy. We're going into August. We're supposed to be traditionally a bit of an August slowdown. Doesn't seem like we're going to have one. It's just busy. There's headlines constantly being made every single day. Even tonight, I'm like, okay, there's gonna be this coming out, and we're having a discussion.
Yeah, it's I as much as I like some time off to relax, we would welcome the volatility. I mean, that's we say that's when the job gets interesting, and that's when you can, if you got a level head, you got a good team, you do good underwriting. That's how you can make your year or more. I hope you're right. I hope this is kind of a sign of more interesting things to come. And I think more likely than not, it will be.
And so we're going to have probably a busy couple of months. What else are you sort of thinking about right now that we haven't hit? We've talked about AI. We've talked about Iran war and inflation and the Fed and private credit. Have I missed something that you're thinking a lot about right now?
I would just say, the world has shifted a bit. I think the things we're going to be talking about over the next couple of years will be a little bit of a shift away from private credit and into asset-backed finance. I think that actually opportunity set's even bigger from a dollars perspective than private credit. It takes, it's a little different from an underwriting perspective, but nonetheless, I don't think the whole concept of disintermediation of the banks has gone away.
No.
They may be stepping back in a little bit, but this whole private capital solutions and the trend we've seen for over a decade will continue. So that's something really interesting.
And it really has been interesting. And thank you for coming back on the show. I really, really appreciate it. And I would love to have you back on. This is such a fun conversation for me to have with you.
Yeah, likewise. It's a pleasure to always be here. I look forward to the next time.
Great. Thank you so much. And to our audience, thank you for joining us. And do follow us on YouTube. We're on YouTube now. Subscribe. Also, Apple, Spotify, or wherever you get your podcasts. This has been Lisa Lee. Thank you.